Going to be going through a range of attempts of the SA2 exam. Even though it's set for the UK, I'm going to be going through it in a South African context. So, just going to be going through things question by question, what I thought, and a couple of reflections that I had. So, the first question from the 2005 paper states that a UK life insurance company sells mainly unit linked contracts. The board of this company has agreed a merger with another life insurance company that also sells mainly unit linked contracts. Both companies operate a range of unit linked funds, including equity, fixed interest, property, balanced, or managed funds. As an actuary employed by this insurance company, you have been asked to provide advice to the board regarding the potential for mergers between the unit linked funds of the two companies. So, just going based off of this alone, the things that sort of just stand out to me are going to be that, they mainly sell unit link contracts. So that would mean that they're either using IFRS 9 or IFRS 17 reporting for the most part, and they're using a VFA methodology to calculating their liabilities. Um, the merger with another life insurance company also has certain implications. We need to ensure that this is actually allowed in terms of regulatory standards that I'll actually discuss a little bit later on. But the fact that it also sells unit link contracts is a big advantage. One of the advantages is that we can actually capture market share as a merged entity a little bit better rather than a separate entity. It can be advantageous in terms of setting prices for charges, investment fees, management fees, that sort of thing. But again, it has to be approved by the Competition Commission and Prudential Authority because it can make us decently powerful. But on the face of it, a merger means that we'll actually be able to benefit from economies of scale and also other benefits such as like sharing resources, data, etc., etc. The fact that they have equity, fixed interest, property, and balanced or managed funds is also a little bit interesting. The equity, fixed interest, property, and or the distinction of these three with the managed funds most likely means that some of them are managed, some of them are actually not managed. Um, Equity, the actual equity that we're invested in might actually range. It ranges from insurer to insurer, so that's not too interesting. Same with fixed interest, really, and property. Except that we can directly or indirectly invest in property and then a balance fund. So this is just a typical unit linked structure for a life insurer, which isn't that anything specific. The interesting part of this question is says that as an actuary employed by this insurance company, you have been asked to provide advice to the board relating to the potential um, for mergers between the unit linked funds of the two companies. So, although I am an actuary employed by this company, I can provide some advice. But again, in the actual process of the actual merger, my advice will actually be null and void because there are going to be conflicts of interest since I'm employed by one insurance company and not the other one that we're merging with, right? So it's most likely the case that if we were to go through with this merger, we would have to have an independent actuary to actually properly come in and view the factors and like what's going on in general, etc. So now that we've actually evaluated the scenario, let's get into the questions proper. First thing is describe the key factors that should be taken into account when considering whether or not to merge the unit linked funds. So a lot can be said about this, but I think just to narrow down the universe of answers so that I'm not actually writing down just anything. I'm just going to be writing down the factors that are make or break with regards to the merger considerations. And they're actually going to be split into two factors. The first factor is regulation, and the second is pricing. Then after that, I'm gonna go through what the memo said, and then just have a couple of reflections, like where I could have improved and so on and so forth. So, before actually going into my answer, I first want to start with APN 108, which are practice notes that are provided by ASA with regards to specific transactions that insurers want to partake in. So the transfer, merge, restructure, close down of insurance companies, they are actual guidelines for the independent actuary that are prescribed in APN 108. It is a hefty document. I think it's about 10 pages, but I think the key takeaway from APN 108 is that the actuary needs to follow certain rules and they need a formal brief from the PA, which has the terms of reference. And the independent actuary needs to work independently and not let the insurer or the party influence the findings, and we need to have access to all our necessary documents. And then the Prudential Standard GRI, it's this governance of operational standards for insurers, which it's just a set of rules set by the PA with regards to these big transactions. Again, mergers, restructurings, conversions, and fundamental transactions. We have APN 108 and GRI 6. GRI 6 should be followed. There is some overlap between both APN 108 and GRI 6, but GRI 6 should be followed first and foremost before APN 108. APN 108 is more so for the independent actuary themselves once they've been chosen, whereas GOI 6 has even harsher rules with regards to the choice, the processes, the documents required, how or the situations in which a merger will be accepted or denied by the PA. It's just a stronger prescriptive regulatory standard. So if we're considering mergers and acquisitions, we need to have these at the back of our mind. We won't necessarily just like copy paste these into the actual answers when we're considering the key considerations, but they should be at the back of our mind. So in structuring my answer, I said that both companies need to meet the prerequisites for the merger according to GOI 6 and APN 108, which means that once the merger occurs, there needs to be a good financial health or an improvement of the financial health of both insurers and the maintenance of the RBEs of the policyholders, the reasonable benefit expectations. So the reason why I just included like one point with regards to the actual regulation is the fact that I need to provide an opinion of the other insurance company. I'm not directly involved with the other insurance company, so most likely I can use some published records, and it should be known that published records are set a little bit different from the supervisory standards. The published records use the first 17, and the supervisory standards follow FSI, FSV standards. So I'm going to need both information since there are certain nuances and differences between liability treatment. So I can actually see the financial health in an objective sense. Then after that, another key consideration is the fact that we need approval from PA, and we need the required information in the required detail. So again, the PA will also consider our market share control. So if post-merger we control a large part of the market, then that merger might not actually occur at all. So we need the PA's actual approval. So it's either we appoint an independent actuary or the PA does it, and we need to be able to demonstrate the independence and expertise of our actuary that we appointed to the PA. And again, the merger can't coincide with the Competition Act of 1998. I sort of spoke to that a little bit earlier. And now we need to actually class the different types of unit linked funds. So there are purely investment linked unit linked funds, and then there are also risk based unit linked funds. So there's going to be unit linked funds where, okay, if you die or if you're critically ill or if this happens, then a benefit payout will happen based off of the value of the underlying unit. However, insurers also have the opportunity to provide unit linked products that aren't linked to any risk component. And the treatment of those two is actually different. If there's a risk component, then um, we need to report this under IFRS 17. If not, under IFRS 9. So we need to find out whether the other insurance company is just has purely unit linked, like purely investment unit linked, or whether have they have risk based, and sort of like the clash of accounting standards that will occur if we merge these two. So if there is a massive difference, then it could lead to an overcomplication of reporting standards, and we need to ensure that we have like the expertise and knowledge. Then we have the pricing factors. Um, the actual unit funds themselves, they need to be consolidated. So if we have a balanced fund and they have a balanced fund, firstly, we need to ensure that our definition of balanced fund is the same thing. Our assets under the balanced fund could be materially different from their assets under the balanced fund. If those assets are different, then it could cause issue because once we actually merge and then we reprice these units, one side of the policyholders might say, "Oh, shoot, our unit prices actually increase," and the others will might be complaining that their unit prices decrease. So we need like a fair treatment of that. We need to consider the bid offer spread, charge structures, allocations of each um, company before we consolidate. And then also the composition of customers might be different. So, like, we might have different risks that we face, surrender values, options, guarantees, which will change the overall risk component. We need to ensure that we're actually competent in measuring these new risks that are actually, that come up after the merger. And we also need to see if there's some diversification benefits or economies of scale because of said merger, like the actual advantages. So if we also need to look at the unit fund reserves, non-unit fund reserves, and the any philosophy with regards to the investments and unit price calculations, that sort of thing. So we need to consolidate those things such that none of the policyholders from company A and company B are actually treated unfairly. So we should also ensure that during the merge that there should be a fair treatment of policyholders, and of course the actual pricing basis. We're going to use the VFA under IFRS 17, and the assumptions for the VFA use or any of the pricing models need to be the same between the two. So that's basically my take on the question. The memo had a there was a bit of overlap between my answer and the memo, but there were a few differences. So here, the extent of the of the similarity of the funds, I discussed that, and then again, here the whole balanced company A, balanced company B, and the expectation of the policyholders, I discussed that as well. I also considered the costs and the cost savings of the economies of scale. So I didn't explicitly mention the costs associated with merging the funds. I should have done that. I only mentioned the economies of scale, but there are certain costs associated with mergers, acquisitions, or any type of these transactions. There's legal costs like regulation and enforcement costs, there's compliance costs, there's IT costs, tracking costs, that sort of thing. So the actual merger in itself is going to be a transaction that is going to need some sort of budgeting, right? So we need to set some sort of money aside. So this I neglected to mention. I just mentioned the economies of scale. I mentioned that we need the fair treatment of policyholders, um, but I did not mention the actual notification of and the policy literature or make any reference to that. Um, the IT systems, I didn't make mention of the IT systems or them being able to handle the actual merger or perform the actual merger. Um, Here, the nature of the agreements of the external fund managers, I did not mention this as well, like the clauses that make the mergers less attractive. And then the sizes of the fund are very important, but I neglected to mention that as well. So merging larger funds is going to be a little bit difficult, but merging, smaller funds might be a little bit easier. So the unit funds, I actually mentioned the unit funds, and then I also mentioned the operational issues and the reputational risk, but I neglected to mention the marketing issues. So the answer was more practical with regards to the merger, but I was more concentrated on the regulations. So the answer focused more on the communication to the policyholders, the IT systems, and the size of the funds, where I just mentioned uh, just very regulatory and like pricing schematic things and did not mention anything outside the realm of that. So it wasn't a completely well done question. I could have expanded my breadth because the memo included the types of funds, the size of funds, the costs, the IT systems, the penalties, operational issues, and marketing issues, whereas I only considered regulatory issues and pricing issues, two factors, and then went deep into that. Whereas the memo had an approach where it didn't go deep into things, but it just mentioned a little bit about a lot. So, it has now been decided that the two sets of unifunds should be merged. Discuss the key considerations for the new combined company regarding the calculations of the unit prices at the merger date. So, this actual question is it's a bit tricky. It was a bit of a tricky question, and we need to ensure that we actually answer the question. So, this is just the consideration, new combined company, calculating unit prices at the merger date. So it looks like what a lot of people did is that they just gave the process of calculating unit prices um, and didn't focus on the merger date because that is a very important date. So just in a sort of like background, when these unit prices are valued in the unit linked funds, the assets are split between liquid and illiquid. So liquids, first, or the first step in actually valuing these units is we need to value the underlying assets, which can be liquid and illiquid. The liquid assets are really easy to value because those are traded regularly and openly in the market. So we can quite literally just look out in the market and see what price this asset's going to be priced for, and then say, okay, cool, this is the price. Illiquid assets are a little bit uh, challenging. They might need appraisal, like first if it's just property and we need a property appraisal, or they could just be an arm's length transaction. So like if we actually sell it, how much will we get in an arm's length transaction? So prior to the actual merger. So now that we've valued the assets, we need to determine the pricing basis. There's the bid price and the offer price. the offer price is higher than the bid price. The offer price is the price at which the insurer offers policyholders to purchase the units, right? And the bid price is the price at which we purchase the units from the policyholders. So there's this sort of like bid offer spread. So once we determine the pricing basis on the day, um, then after that we can move to the next step. So there are other things like acquisition and proposition bases, but this whole bid offer price is more um, it's more digestible. Then after that, we calculate the unit price, taking into account transfer duties, taxes, costs, expenses, and other frictional costs. So this is usually the pipeline of how companies value their units. But again, it very much differs from company to company. There isn't a prescribed regulatory approach, and thus insurance companies usually have some sort of principles and practices document, um, or statement of intent, or investment policy statement, that sort of thing, that actually describes the calculation of the units, like what time they're calculated, the models that are used when calculating them, whether Black Scholes is used or any other option pricing, just different aspects. So this all differs from insurer to insurer. So the question actually asked the factors we need to take into account when calculating the unit price on the actual merger date. So I said that prior to this, there needs to be a consolidation of funds. Like if there's a balanced fund A and there's a balanced fund B, there needs to be a consolidation of funds. So it's either we calculate separate unit prices. So even though prior to the merger, both companies had a balanced fund, right? And when the actual companies merge, instead of just having a balanced fund, we'll say, okay, this is a balanced fund A and this is balanced fund B. And if you're part of balanced fund A, cool, you're part of balanced fund A. And if you're part of balanced fund B, then cool, you're part of balanced fund B. So the separation makes everything like a little bit easier, but if we consolidate these funds, so if we want an all-encompassing balanced fund, we need to ensure that there aren't any arbitrage opportunities. So there aren't any like material differences in the actual pricing. And this can only rarely be done if they're both balanced funds are practically the same amount of assets, the timing in which those assets were bought are the same, the pricing mechanisms are the same, etc., etc. Otherwise, there's going to be arbitrage opportunities, which is going to lead the policyholders to withdraw their contracts if they find that, the unit price suddenly shot up. Or there might be reputational risk if they find that the unit price suddenly shot down. In any case, we need to prevent this with some sort of pricing correction mechanism. So again, we need to ensure the treatment of all customers in a fair manner. Then I actually go into detail on the pricing of the assets, which is similar to what I discussed before. But I go into a little bit more detail with the actual regulatory prescriptions and also some practical implications of mergers between the different pricing schemes, the consolidation of the pricing schemes, and appraisals. And then I go into a little bit of detail on the pricing basis. Again, the pricing basis is different from before. And then I go into detail on the calculation of the unit price and IT systems and requirements, and then also emphasize that the decisions made above should be open, transparent, and there should be communications to policyholders. So, with the memo, I mentioned everything in the pricing basis, which was fine. The system and administration basis was good and mentioned as well. I also mentioned tax, but tax was sort of like a loose mention in my answer, but it is very important, um, because there were certain events in 2012 and 2016 within South Africa where the capital gains tax or the effective tax rate for the capital gains was increased for institutional investors, which means that the assets had to be sold and bought effectively by all insurers at those specific dates. It's a little bit confusing, but there was a massive tax liabilities that insurers faced at those dates when there was an increase in the capital gains tax. And this tax liability could be amortized for over 5 years or a contract boundary period. In any case, tax is something I only briefly mentioned, but it is very important. The tax assumptions, meaning how the income tax, the dividends withholding tax, and the capital gains tax, and how that's actually priced in, amortized, that sort of thing, how certain tax liabilities are calculated in terms of gains and losses, and how they're cancelled out. So the practices of the companies with regards to tax need to be similar. I should have definitely mentioned this, and I did neglect to mention that. And then also the pricing, something that should have been glaringly obvious, but I neglected to mention was the timing. So all of these assets, the time at which they're measured or valued actually heavily impacts the prices of the units. If they're priced at different times of the day, we need to actually consolidate this. So if insurance company A priced at the beginning and insurance company B priced at closing prices instead of opening market prices, we need to fix for this. If the policyholders are used to next day or previous day prices, we need to make fixes for this, and the policyholder literature actually needs to be adjusted to correct for this, and it should be communicated to policyholders. So the tax and the timing is two things I neglected to mention that I should have mentioned. Yeah. Then we go into the third question, which is less so of an insurance question and more so of an investment management question, which I actually failed to answer because I neglected to answer this part of the question. So it said discuss the key consideration for the management of investments in the merged unit linked funds, including guidelines on the portfolio of assets to be held within each fund. So I answered the first part of the question, but I did not answer the second part of the question. And it should have been a red flag to me because the first part of the question is really generic. It's the second part that's the actual application portion. So, anyways, let's just go through my question with regards to the actual management of the investment funds. I spoke about the investment management managers, um, the key decisions with regards to the choice, measurement of performance, GRI 5 standards with regards to outsourcing, and the key choices or the key characteristics that need to be evaluated when actually choosing these fund managers. Then I broke down the philosophy of the investment fund. So when they're merged, there are certain things like ESG concerns or Sharia compliant funds that we need to abide by, passive or active strategies, diversification strategies, just the philosophies and views of the board. And then the risk management, I went into detail on GRI 3 standards of internal controls and risk management and the evaluation of the assets as well, prescribed by LTIA Schedule 3, and the appraisal of these assets, as well as the risk measurement, identification, monitoring, transfer, etc. All about risk management. Then I went into people, systems, and processes. So, like our IT systems need to handle the daily pricing. We need to have access to software, training platforms, etc., etc. And then I went through the regulations. So, if one or there aren't necessarily any prescriptive regulatory requirements for insurers with regards to investment practices. But if we provide retirement annuities that are unit linked, or any retirement products like endowments, that are unit linked, then we most likely need to, or will definitely need to abide by Regulation 28, which has limitations on the proportionate asset basis that we can have as an insurer. And then I just have some disclosures in terms of cost and performance measurement and the EAC and TCF requirements by ASISA. And that was pretty much my answer. The actual memo spoke about the fund managers, which I spoke about. It spoke about the guidelines, which I spoke about, as well as the practical considerations. However, I didn't make mention of the investment vehicles. So, again, since we are invested in property, we could be invested in property directly through REITs, collective investment schemes. So that's something I should have mentioned as well, that I neglected to mention. And then there's the second part of the question, which I didn't answer, which is them actually going into detail on the management of each of the assets. So the equity funds, fixed interest funds, property funds, and then the balance fund. So this I did not mention because I didn't read the question properly. Fixed interest fund, I did not mention. This I did not mention as well. And this I did not mention. So here we have um, the equity funds. There's just certain things with regards to the types of equity funds we could be invested in. The same for the fixed interest funds, certain benchmarks, certain assets, same with the property fund, and same with the balance fund. So it was just like a basic description of these things, the asset mix, performance review, and the actual measurement. So upon reflection, I thought that this question was okay, but I think it went a little bit worse than expected as I'm marking, and because I'm trying to be a bit strict on myself. There are a few things that I missed because I didn't answer the question properly at the end, and there are a few things that I missed in question two, especially because I didn't go a bit deep enough in question one in particular, where I didn't consider any other practical implementations. But this is my, first attempt at the question, first question, and hopefully there's an upward trend improvement.